if you wanted to talk about a sector or a set of sectors in news, then, and currently in India more so, this is just the next 15 minutes is going to be talking about that, because our guest today heads Telecom in Asia, Asia Telecoms and India TMT for JP Morgan, Ankur Rudra. Needs no introduction. He's been on our platform a number of times as well. Ankur, great having you. Thanks for joining in.
Thank you, Neeraj. Good to see you.
Yeah, likewise. Great. And thanks for having us at your conference too. Ankur, let's start off by talking about what has been in the last 36 hours for you, the most exciting part of this conference, and give us a sense of what have conversations looked like in this conference with investors and yourself, and with you talking to some of the participants.
No, sure, absolutely. So, we've had a great first day at the conference yesterday. We had lots of, very interesting speakers, including, the Minister for Railway and IT. We had very, interesting heads of some of the biggest manufacturing companies in the world on the tech side and on the AI and semiconductor side. So lots of very interesting conversations about how semiconductor manufacturing and increasing amount of overall building of the semiconductor ecosystem is happening here. I think that's been a key area of conversations. We've had a lot of conversations with investors on, of course, the IT services sector. There's been an element of pullback in the sector recently. There's some, expectations reset, perhaps. It's a time where we're sort of setting up the expectations for earnings. So there's a conversation about that. One of the big global companies is about to report this week. There's some expectations about it. And of course, on the internet side, there are stocks which continue to do very well. Sectors which have done extremely well and they've been discovered. So there's been a lot of conversation about food delivery and quick commerce. It's been the flavor of the year, if not the last 6 months. And of course, telecom has been in the news constantly, as recently as over the weekend. So it's been very, very interesting. We've had very interesting conversations and debates with investors and participants.
Yeah, indeed, most so. So many questions. But Rucha, you want to start off with, let's start with one of the themes.
Right, let's start with IT. I mean, that's under focus. So just one question around the demand side. The demand has been under pressure since 3-4 quarters now. So what are clients saying about their budget, CY 25 budgets? Are they really accommodating IT spends, or are they still waiting for the macro issues to get resolved?
Great. I know. Thank you, Rucha. I think what we've seen very interestingly, right? If you slice the sector breakup for revenues for the big IT companies, you'll see financial services by far is the biggest. And one of the positive surprises for this year has been how the trend for tech spending in financial services, especially by the biggest banks, the big globally systemic important banks like the big 5 US banks, they've seen a trend increase in tech spending. Year-over-year tech spending is improving this year. Part of that reflects perhaps improving investment banking and corporate investment banking revenues for many of these companies. We are also hearing and seeing more confidence from companies who talk about financial services recovery, especially from US financial services. I think that's helping to an extent. But if you look beyond US financial services, the picture is a bit more, I would say, mixed. There is sort of mixed trends, especially in other industries. Even financial services beyond the US is not as strong yet. But financial services is clearly one sector which is seeing a recovery. The second biggest sector for the industry, for the IT companies, is the TMT space, where we haven't seen a broad-based recovery. Where you don't have that level of confidence overall. That has to recover for the overall sector to see recovery. There are a few sectors which are doing very well for a while. Travel, parts of healthcare, which have been strong, utilities to an extent. And autos, of course, that's been doing extremely well. So those are the slightly stronger sectors. TMT and, FS is coming from a very low base. So it's not at a point where it can potentially guarantee double-digit growth next year yet, but at least the trend is positive. So I think that's been the main incremental demand change we've seen in the last 3 to 6 months.
Right. So just to follow on, so the deal cancellation and deal pauses, which was the major factor around last 2 quarters. So do you think that continuing in the second half of FY24 as well?
So I think what we've seen is on discretionary spending. Discretionary spending really slowed down from late 2022. So we are now in probably the 9th quarter of weak discretionary spending. But within financial services, since the beginning of this year, the commentary has begun to change. So we heard about green shoots in financial services, discretionary spending to an extent. I think that became more common over the course of the June quarter. And I think over the course of this quarter, it's become almost a chorus where I think Q1 results, almost every company agreed that financial services discretionary spending outlook is improving. and many companies have called it out very publicly. So, this is potentially the cancellations, like you said, or the pauses or the ramp downs. That's not being a headwind anymore. So, at least in financial services, we are hearing from a range of company participants. We are seeing this in tech spend numbers by the big banks, like I said, and this is broad, slightly more uniform industry commentary that is definitely looking up. It's not recovered to the extent we had during 21 or so, but it's definitely on the way up.
Right. So, okay, let's talk about ER&D now. That is the much more in demand, and many big IT companies are also acquiring those small ER&D companies as well. So, what's your take on the growth in that segment? Do you think that the big IT companies will now foray their hands into the ER&D space, and there's no room for the small ER&D companies to grow now?
Yeah, I think it's an interesting question because, see, ER&D is a relatively underpenetrated subsector of IT services. So secular growth remains very positive, and we are positive about the long-term secular trend in ER&D. It should see growth, and it's a more diverse set of industries. It's not financial services or TMT heavy. It's a lot more of auto, manufacturing, industrials, parts of semiconductor, for example, parts of medical devices. So, and again, aerospace and defense. So we've seen some of them doing well. Autos is being consistently doing very well, and the companies exposed to autos have been one of the best performers in the sector. Right, for the last 3-4 years, consistently, and perhaps also more premium than the rest of it. But if you look at the other sectors, so companies which are more diversified, which have got an exposure towards TMT or aerospace, they have struggled to an extent, or communications, they've struggled to an extent. We are expecting in parts of those subspaces, so TMT, maybe aerospace and defense, sustainability to begin to recover for the next 2 or 3 years, and hence that will improve. Now, you're right, we have seen at least 2 or 3 big companies make acquisitions on the ER&D side. Now, ER&D is relatively big. It is also very fragmented. I think it's too early to say there won't be any space for smaller companies to grow, because even IT services, you had smaller companies doing a lot better. I don't think it necessarily comes at the cost of large companies or the other way around. The market is big enough for all of them to do well. It's sort of early days. I think while ER&D has been a part of every large tier 1 IT services company, and if they were to be listed separately, it will be bigger than all the independent companies out there. So I think this probably gives them an edge on, or gives them an entry into auto, which was doing extremely well. I think they're trying to catch up, as opposed to, I think it's too early to say that the smaller companies will struggle because of this.
So just wondering, does this change your outlook and your, let's say, ratings for any of these companies, both the ER&D because of the fact that there is heightened competition, and even on IT services because of the change in the commentary in FS or financial services viewers? Are you a lot more constructive now? What has been your messaging to clients who are asking you whether to buy or not buy?
So I think what we've been saying to clients is, auto ER&D has been doing well, but it's priced in, right? Okay. It's priced in. So, we are a bit more, I would say, we don't find that much value there because it's priced in. It's among the most premium multiples out there. And the risk potentially could be on the downside for some of them because the expectations are high. Financial services the other way around. Expectations are only getting built up right now. And perhaps there is room for, more legs on the growth story here. Typically what we've seen is multiples tend to keep going up when earnings upgrades happen, when revenue upgrades continue to happen. And we are, I think, probably in the early phases of that. We've just seen a reasonable sized rate cut. I think JP Morgan expects there'll be a few more, not just this year, but definitely the year after this. And that would help discretionary spending in banks, in the discretionary parts of banks' revenues, which will drive potentially tech spends as well. So what we definitely, at the moment, we are recommending investors to go for financial services focused exposure companies over auto ER&D because auto ER&D is more priced in. We are probably at the mid-cycle. Whereas in financial services, we are in the early part of the cycle.
So large, mid doesn't matter, but financial services. Exposure to that. Okay, and just part 2 of my question on internet services-based businesses, because they have really done well. Almost everything out there. Some of might be under your coverage, some might not be. But what's your overall theme?
Sure. So what we like right now in the consumer internet space is we like the opportunity around food delivery and quick commerce market. We also like some of the large OTA markets. So what we like is basically platform companies who have established very strong market leadership, who've proven profitability, who've proven the business model, where there is a significant amount of attractive growth and meaningful amount of operating leverage. So if you've shown operating leverage, if your gross profit margins are good, which many of these companies call contribution margins or contribution profits, and you are able to show operating leverage on indirect costs, your EBITDA growth can be significantly stronger. So those companies which fit that theme, and of course, in many cases, they tend to be market leaders, they are, I think they will keep doing well. And those companies have been discovered. What's also happened in these companies is valuation multiples used to be pegged to global benchmarks, used to be pegged to revenue when they were not profitable. All of these companies have turned profitable, not just at the adjusted EBITDA level, but also at an EPS level. And they are now being compared with the rest of their peers who are not consumer-based. Now, these are potentially higher ROIC businesses, lower capex intensity, and I think that's doing really well. Within the food delivery and quick commerce side, quick commerce itself is a significantly disruptive digitization change in consumer behavior. We are seeing, habits change, consumer habits change very rapidly. There's a channel shift happening away from modern trade, away from e-commerce towards that. And effectively, you're playing into a, maybe a, generational change in consumer behavior that these companies can offer to you.
Right. So just talking about the valuations part of these new age tech companies, so for example, when Zomato was much newer, like say 2-3 years back, we used to compare Zomato with someone like Meituan, right? But that's not actually comparable because Meituan is like an established global company and Zomato is not. So my question to you is, how do you value a new company wherein you don't have, you don't have any base to compare it with? So what kind of valuation multiple is justified to such companies?
Sure. I mean, again, we can't name companies at all, but I think I understand the question. So what we found is that in the past, when Indian consumer companies were in the value discovery space, which is when you had established comparisons either in China, because that's one of the biggest listed markets, in Asia among emerging markets, and in the US. And over time, I think what's proven is in the Indian model, the outlook has been the outcome of many of these companies have been different. We've seen better market consolidation. We've seen probably better discipline. And many of these companies have turned profitable, potentially faster. There are differences in competitive dynamics. There's differences in labor dynamics, which makes them potentially more profitable than what you see in their peers in other regions. So as a result of this, when one was comparing only with a market, which at the moment is not growing, it doesn't seem fair. So Indian growth potential for many of the consumer tech businesses or consumer internet businesses is a lot better than what you're currently seeing in, as an example, maybe Chinese tech companies or even US tech companies. Partly we are at a lower level of penetration, partly because there can be stronger, longer-term consumption growth, aspirational consumption growth, and they're all plays on that. And as a result, we think the potential better comparables on a multiple basis is maybe real consumer companies, which can reflect similar sort of demands, over time. And again, these are all profitable. So profit multiples make more sense as opposed to revenue multiples.
Let's move on to telecom.
Yeah, well, let's start with that. No, I was just wondering. So the consumer multiples in India have been sky high for years now. You expect those to be the normalized valuation multiples for some of these businesses?
See, from a model perspective, if you think about medium to long-term ROIC generation, medium to long-term free cash flow generation, these are, many of the platform companies that I mentioned, they are market-leading companies. They're able to capture a significant amount of value. If they are able to hold that value, then they deserve those multiples because your ROIC in the long term will be very high. Your profitability and your free cash flow generation will be very high. And your growth potential should be at least equal, if not better.
Oh, certainly.
Right.
Telecom.
Let's move on to telecom. The most talked case is the AGR use case. So just wanted to know your understanding on, do you think that this AGR case will now be reviewed by the government, and is there any possibility of this going on in favor of the telecom companies now?
Thank you.
Or is it like done and dusted?
Thank you for putting me in a spot. But what I would say is that, look, we've never assumed in our base case for any of the telecom companies for this to be reviewed in the past because it was a curative petition. The Supreme Court had ruled on this, so we have never assumed in our base case for any of the companies we covered that this would happen. If it did happen, we had high case scenarios that would help some of the companies to a lesser extent, some of the companies to a much higher extent. And at the moment, this would not be in our base case at all. We would assume that companies have their own business plans, and life goes on without it. Now, this government has been clearly very supportive of the industry. There have been public statements to the effect that they want to support very strong, competitive, multi-player market. And they have taken policy actions. There's been regulatory reforms and multiple telecom reforms that have supported it. So we'll probably keep seeing things on that nature playing out. Whether this will result in a specific action on the AGR front is very difficult to say, but our base case remains that we don't see any incremental relief from here.
Right. Let's talk about the tariff hike. Okay, many companies are talking about how tariff hikes would help them, and in fact, tariff hike is necessary for them to achieve that kind of ARPU. But then the July TRAI data, which we saw, wherein these guys hiked their tariffs, they actually lost subscribers to a great extent. So, do you think the next tariff hike cycle would make them lose subscribers, or subscribers are generally price inelastic?
I think what's very interesting this time is that the churn happened away from the telcos which took a tariff hike to the telco which has not taken a tariff hike, but also made very small amount of capex. So network upgrade is very, very nascent, whereas the amount of investment and the quality of network by the other private telcos is significantly higher, including another telco which is planning to do that as well. So the key question is the churn a one-time thing? Is it here to stay? We've only seen 1 month of data. And again, the churn has happened primarily at the lower feature phone, end market level, where tariff increase has not been very significant. That segment is price sensitive. But if you look at the tariff increases this time, they were not uniform. The tariff increases at the feature phone level were relatively lower. The tariff increases went up, a bit more on the smartphone side. And in fact, the tariff increase for entry-level 5G plans was the highest. So there is an element of grading on the tariff increase. And India probably needs more market segmentation. If you look at the price of data on a per GB basis, effectively, or the bundle plans in general, it remains one of the most affordable across emerging markets, if not the world. And as a result, there is scope for potential more tariff increase over time. And I think most of the telcos keep talking about it. So we would expect India to remain in tariff repair. We've been in tariff repair for the last 6 years, and the tariff repair should continue going forward as well. Extent of tariff increases, we've already baked in another 15% tariff increase late next year. We have not baked in anything in calendar 26 or fiscal 27. It's possible that we keep seeing this going forward so that the ROIC is more reasonable for all the telcos and for this to be a relatively healthy market.
Okay, so the 1 month data doesn't quite deter your thesis of a price hike, does it? Does the rally in some of the stocks make them less compelling, or do you believe there is an investable case out there? There's only a handful, so people will be able to guess what you're talking about, but I mean, just trying to understand, do you believe telcos are a buy here?
Sure. So look, we like Indian telcos in general, partly because we are seeing two factors play out. One, we've seen capex intensities behind, so capex on an absolute basis is falling. For most of the telcos, of course, one is in a different cycle, but for most of the telcos, capex intensity is falling. And with tariffs going up, not only this year, but next year as well, revenues will keep rising, right? And EBITDA will keep rising. So capex as a proportion of revenues, or capex intensity, will fall at a rapid rate. ROIC expansion will increase at a rapid rate. So the EBITDA, EPS growth that telcos here will offer, the ROIC improvement that will happen here, will be incomparable, which we see in rest of Asia. For example, in Asia, we've got other markets also where there is tariff repair. Thailand is in tariff repair right now. Taiwan is to an extent in tariff repair. Philippines is in tariff repair. Indonesia to a lesser extent. But the extent of tariff repair in India is significantly higher, and the durability is a lot more. So that keeps it a lot more attractive on a thematic basis.
Just a follow-up question. Do you think the tariff hike is already priced in the stocks?
Yeah, the current tariff hike is priced in. I'm not sure the tariff hike potentially for next year, or if one happens the year after that, is fully priced in.
Got it. Great. Ankur, such a pleasure talking to you. Thank you for taking the time out and being with us, and have a great remainder of the conference.
Likewise. Thank you so much.
Pleasure was ours, and viewers, thanks for tuning in.